Hello everyone. In this part of our lecture, we proceed to the next group of investment project appraisal methods, which are based on discounted cash flow analysis, net present value, and internal rate of return. And hopefully, by the end of this week, you should be able to explain why these techniques, discounted cash flow methods, are preferred to traditional methods which we've covered previously, payback period and accounting rate of return. You also should be able to calculate net present value and internal rate of return for a variety of investment projects. I would like to draw your attention that for this specific topic, it is very important to do practical exercises. That is why please make sure that you attend your seminar and attempt all of the exercises in order to master these key skills. They are very important for your next assessment and for your future professional life as well. Let us start. First of all, let's discuss why do we need to introduce these discounted cash flow methods. The thing is, the purpose of allocating capital to a particular investment project is to generate cash inflows in the future. And apparently we expect to get significantly greater cash flows than the amount we've invested. Apart from this, from economics, we know that any decision, including investment decisions, involve opportunity costs. Investors have alternative uses for their funds. They have opportunity costs if money is invested in a certain corporate project. That's why investments must generate at least enough cash for all investors to obtain their required returns. If they produce less than the investors' opportunity costs, then the wealth of shareholders will decline. Another factor which will also play its role here is the time value of money. In other words, the idea that a sum of money today is worth more than the equivalent sum in the future. In other words, when we try to analyze a certain investment project, we need to take the timing of cash flows into account. That is why, in order to make sensible investment decisions, we need to develop certain investment appraisal methods which will both consider all costs and benefits, in other words, cash outflows and inflows of each investment opportunity, but also make an allowance for the timing of those costs and benefits for cash inflows and cash outflows. And discounted cash flow investment appraisal methods allow us to do just that. And these two, net present value and internal rate of return, are two methods which we are going to cover in our lecture. This is part of our syllabus for this module. Let me give you an example. Let's imagine that we have two investment projects, Project A and Project B, which will generate these net returns. So these are inflows net of any costs associated with these projects. Both projects will last for 4 years and both projects will generate £200,000. The question is, which project is preferred? If you were working as a financial manager for a company, which project would you recommend and why? Please stop the video, think for a minute, and continue when you are ready. Ready? Got any ideas? Generally, both projects do generate the same returns of 200,000. However, the timing of these returns is different. We get higher returns early on in Project A, but in Project B, they are delayed till year 3 and 4, towards the end of the project. And because of this, Project A is preferable because it generates higher returns sooner. Financial managers and companies frequently face situations like this, a number of alternative projects with different cash flows which occur at different time periods. And we do need a certain investment appraisal method which would allow us to make a decision, to get a clear answer which project we should select. Is there a good analytical method which is able to give us a clear and unambiguous answer whether we should invest in a certain project, or possibly our money should be invested elsewhere? And if we do have a choice between alternative projects with different cash flows, which project should be selected? Based on what criteria? We need to be able to compare various investment opportunities based on their net values in today's terms, and discounted cash flow methods allow for this. These methods discount all future cash flows of a proposed investment and bring them all to today's terms. So they create some form of common denominator, if you like, because they allow to determine a project's net present value for each of possible investment opportunities. We do create this common denominator, which we can then compare for different projects and make an investment decision based on this specific criteria. So let's see how it works. Our first method, net present value. This is simply a sum of present values of all projects' cash inflows and cash outflows, discounted by the company's cost of capital. In other words, an investment proposal's net present value is derived by discounting all future cash flows at a rate which reflects the value of the alternative use of the funds. And usually the discount rate, which is normally used to calculate net present value, is the weighted average cost of capital. You will study this specific concept in significantly more details later in your course of studies. Investment projects with a positive net present value are expected to generate a higher return which exceeds the cost of capital and therefore will increase shareholders' wealth. We aim to find investment projects with a positive net present value. And here we have very simple decision-making rule. If present value is 0 or positive, we should accept this investment project, or we reject it if the net present value happens to be negative. In other words, you should only invest in a particular project if its net present value is greater than 0, if it is positive. Moreover, if you face with a choice between different alternative mutually exclusive projects and all of them have positive net present value, you should select the project with the highest net present value. So the higher it is, the better. Next, how do we calculate the net present value? This is the official formula which you should use to calculate it. It might look complex, but in fact it isn't. It simply shows that the net present value is a sum of all discounted cash flows from different time periods. So we do have cash flows which are generated at different points in time. We start with the initial cost of our investment made at time 0, period 0, before it starts generating any returns. Then we have cash flow generated after year 1, cash flow in year 2, and so on until period n. And we discount each of these cash flows using our standard discounting technique, which we've covered in one of the previous lectures already. Here, this formula also shows that the first cash flow taking place in period 0 is not discounted. This specific cash flow, which is normally negative, reflects our initial outlay, our initial investment. It's done now. It's in present terms already. That is why we don't need to discount it. And all other cash flows are discounted. Here, R is the cost of capital, or required rate of return per company. It's hurdle rate. It's also a rate of return from an alternative investment, the return which we might reasonably expect to get in a similar investment carrying a similar amount of risk. Another version of this formula, which might be easier for you to understand and memorize, is this one. So net present value is simply a present value of all cash inflows minus present value of all cash outflows. You can memorize this version if it's easier for you. Why do we need to subtract all cash outflows? This is because net present value does account for both flows in and out. The thing is, most of investments will include both cash inflows, our income, which our investment project will generate, our return, which we hope to get, and cash outflows, some spending which we need to make in order to purchase this stream of future income in the first place. For example, if we want to buy a certain asset, let's say an investment property, rental property, we need to buy this asset first, which represents a cash outflow, which will hopefully generate significantly higher cash inflow in the future. This will be our returns. So this will be our cash outflow and cash inflow. We can also experience additional cash outflows throughout the working life of the project too. For example, we might need to incur some additional maintenance expenditure, or we might need to pay for some insurances regularly, or something else. So cash outflows can happen not just in the beginning of the project, but throughout its life as well. And similarly, cash inflows. Sometimes we start getting inflows very early on, and we will get, for example, with the rental properties, we will get the rents straight away, starting from the next period. Sometimes these cash inflows can be delayed. For example, we might need to renovate this property or build it on a empty piece of land first before we will be able to rent it out and before we get our rental income. Or we might only get a single inflow towards the end of the project. For example, we've purchased a certain property, we've spent money renovating it, and then we've sold it. We didn't rent it out, we didn't get any interim income, we've just sold it at the end of the project. There will be some cash outflow initially and the single large cash inflow at the end, which hopefully should be greater than all our expenditure. In other words, we do need to account for both cash inflows and cash outflows when we estimate the net present value of any investment opportunity. And here outflows are treated in exactly the same way. The only difference is that this expenditure will be negative. Cash inflows will have a positive sign and cash outflows will have a negative sign. In other words, we take them both into account. That is why net present value can simply be calculated as present value of all cash inflows minus present value of all cash outflows. Let me give you an example to make it easier to understand. Let's imagine that you can purchase a certain investment asset which will generate a stream of income of £5,000 per year for the next 4 years. The return from any alternative investment which you can make, for example, you can simply put your money in a savings account, is 5%, and the initial outlay required is £12,000. Should you purchase this asset? Should you make this investment or not? Let's have a look. First of all, I would recommend that you lay out your cash flows. Create a table or something like this, some diagram, which will make it easier for you to see all of your cash inflows in one place. So initially, we need to pay £12,000 to buy this asset. This happens in year 0, before the investment will start generate certain income. This happens now. This is the current period, the present. Next year, we expect to get £5,000 income. The same for second year and so on. For the next 4 years, we hope to get £5,000 in each of these periods. This is our stream of cash flows. Now, because of time value of money, we know that any distant cash flows are worth less compared to the recent cash flows, and we need to bring them all to a common denominator. We need to calculate the current, the present value of all of these future cash flows. We need to bring them all into present. And to do so, we apply a relevant discount factor using our normal discounting formula. So our discount rate chosen is the rate of return in an alternative investment, our 5%, and we need to raise our discount factor to a certain power, which relates to the year, to period in which this particular cash flow would occur. So in year 1, it will be power 1, in year 2, it will be power 2, in year 3, it will be power 3, and so on. If we add up all of these numbers, we will get the present value of cash inflows, which is £17,729. We also need to account for the outflow, in other words, our initial investment. Here, we do not discount it at all because it happens right now. It's expressed in present terms already. Alternatively, what you can also see here is that if you apply the discount factor, it will be raised to a power 0 because it happens in period 0. And here the value of the denominator will be equal to unity because any number raised to a power of 0 is unity. So that is why the present value of cash outflow will just be equal to £12,000 with a negative sign because we need to pay this money. And now we need to add up present value of cash inflows and present value of cash outflows. And if we do this, we will see that the net present value of this particular project is £5,729. Because it's a positive number, inflows are greater than outflows in present terms. It means that it's a great attractive project and we should invest into this. We apply our decision-making rule. If it's positive, we should invest. Next, I'd like to add a few more details about how do you interpret your results, net present value calculations. So this is our stream of cash flows. We've calculated the present value of inflows, which is just over £17,000. In other words, we have purchased an asset, this specific stream of future income, which is worth £17,000. At the same time, the outflows are only £12,000. In other words, we've only paid £12,000 for it. We've got a really good deal. We've purchased something which is worth significantly more than what we've paid for it. That is why we are generating profit from this investment. We are generating an additional supernormal return from this particular project equal to £5,700. And this number shows the difference between the actual value of an asset and the price we've paid for it, because price is what you pay and value is what you get. And this number represents supernormal profit or economic profit. If you recall one of the first lectures in economics part of the module, we've learned that an investor needs to generate a normal profit. And what companies are trying to make, they're trying to make return above this. They're trying to maximize their abnormal or supernormal profit. And this value does represent this. This number actually means that you are generating your 5%, which we've had initially. This is what you are getting. This is your normal profit. You've discounted all future cash flows using this specific number. You are generating this profit and you are generating more than this. So you are earning not just 5% return on your investment, but you are generating 5,700 on top of this. It shows how the wealth of an investor will increase. It gives you a direct number of how much extra you will get as a result of this investment, what you benefit as a result of it, compared to the next best opportunity. So generally, there are quite a lot of advantages of this specific approach because it is directly linked to the shareholders' wealth maximization. It gives you a specific number by which your wealth will increase as a result of a particular investment. Also, it takes full account of the time value of money, unlike all our previous methods we've covered, unlike accounting rate of return and the payback period. In other words, it takes into account that cash flows in distant future have less value compared to more present payments. It uses the whole life of the project in calculations, again, unlike payback period, which ignores everything which happens after you break even. It accounts for all relevant cash flows, their amount and their timing. Also, it uses cash flows rather than accounting profit, which is great because they are not as easily manipulated and they are unaffected by any changes in the accounting policy, which a business can make. Apart from this, it helps you to handle both conventional and unconventional cash flow patterns. It doesn't really matter when your cash flows take place, whether they're even or uneven. You simply lay out a table. You can do it in Excel if you prefer. Just write down all of the cash inflows and outflows which will happen in a particular period, a month, a quarter, a year. Add them up, apply a relevant discount factor, and calculate the total sum. That's it. It's very easy. You apply this technique. And it can be applied to so many different types of investment. Investment in property, investment in financial assets, investment in business. It's applied everywhere. That is why mastering this concept is very important for your future professional practice. Moreover, net present value allows to account for risk because in reality, the level of risk of a particular project is reflected in the cost of capital, which we use as a discount rate for our calculations. You will study this in more details in other modules in your program. However, in spite of all of these numerous advantages, there are some disadvantages too, and you need to be aware of them. First of all, it does use estimates of cash flows, like other methods too. We don't have the actual data for future periods. We only have estimates, which sometimes can be unreliable, especially if the project is expected to last for a very long time. We cannot really be certain that our numbers are accurate if cash flows take place in, let's say, 10 or 20 years' time, because so many things can happen during this period. However, unlike other forecasting tools, it also estimates the discount rate. So in other words, it introduces even more uncertainty into our calculations. The cost of capital, the discount rate itself, sometimes can be difficult to estimate, and moreover, it might change over the project's life. For example, we can decide to invest in a particular project based on certain calculations using a certain discount rate, let's say 8%, but market environment can change after a few years and discount rate can change. Maybe it will increase to 15 or 20%. And as a result, the actual net present value of the project might change after we've committed to this. And the final issue with this is that it's slightly harder for non-technical people to understand. It's not as obvious as the payback period or accounting rate of return. These are advantages and disadvantages. Nevertheless, you need to know that this is one of the most popular and widely used methods of the investment appraisal.